Testing, testing, 1, 2, 3, testing, 1, 2, 3. Testing, 1, 2, 3, testing, 1, 2, 3. What's going on? There we go. Slight delay, it looks like. So, good morning. Let me see if everything's going on. It's running an ad for me. Hi. Oh, and it won't let me chat. Very interesting. All right, well, there we go. I think everything's good. Good morning. Happy Friday. It's the best Friday ever. Trade Non-Farm Payrolls Live, number 146. That's pretty cool. 146 months in a row we've been doing this. So thank you to fxstreet.com for being such gracious and wonderful hosts. They're tall, kind-hearted, good-looking, athletic, artistic people that just were born beautiful. Beautiful babies. Right, FX Street Moderator? FX Street Moderator was a beautiful baby. So anyways, thank you very much for hosting us for more than 12 years for this one particular event. I think that's pretty cool. It's pretty amazing too because I'm only 22. So I've been doing this webinar since I was 10 years old. Seems like it was yesterday. My name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com. I'm wearing my Traders Way colors today, as you can see. Thank you very much for being a client. If you are not yet a client, I would like to earn your loyalty and respect today. And if I do, please visit TradersWay.com. Open a demo account. It takes just seconds, like 30 seconds or something. From there, you can download our MT4 or MT5. Check out our execution speed. Check out our customer service if you want. Check out our spreads. Now, here's the thing. You can choose at Traders Way, because it's your way at Traders Way with Trader Wayne. You can choose between a fixed spread, a variable spread, or an ECN account. How nice is that? Fixed spread you probably want for scalping, or ECN you might want for scalping. And variable spread, if you want a little bit smaller spread when you can get it, right? So anyways, so thank you very much. I'd like to see you over at TradersWay.com soon. Now a little bit about myself. I am an entrepreneur. I'm a businessman. I didn't start as a trader. My first interesting job was I worked at NASA. It's a little engineering firm. You might have heard of it. So I worked there for a bit. A few years later, I was running a company of about 3,000 people, 27 offices across the United States. I was on the board of directors, along with executives from IBM, Arthur Andersen. There was someone from the United Nations on my board. And of course, one person you might have heard of, his name is George Soros, the man who broke the Bank of England. He was on the board of directors with me as well. So my picture is right next to George Soros, well, sort of, is in the same publication. I'm in the, what do you call it, the annual report. So I have a picture of, I have our annual report from that year where I'm on the list of directors, and so is George Soros. So I'm like, look at 6 degrees of separation from George Soros anyways. So that's worked my way to the Silicon Valley, became a relatively successful high-tech entrepreneur. Then I became a relatively successful venture capitalist. Got promoted to vice president of that investment firm. We had approximately 300 employees, and they promoted me to vice president, gave me an office with 3 beautiful windows with a view of the San Francisco Bay Bridge and the beautiful bay. And I thought I was the top of the world. Thought I was top of the world. there was new vice president in charge of a whole new division with an awesome company doing things that I love to do, but I was also trading Forex on the side. Ha, ha, ha. Isn't that amazing? And I got to the point where I had to choose, leave the job I loved and thought I would be doing the rest of my life, or become a full-time Forex trader. So I quit. So here I am. Now I'm just a humble currency trader. But I've been doing this a very long time. When I first started, there were no charts. I knew a couple of professional investors. One of them laughed at me because I was a Forex trader, and he thought that was the dumbest thing he'd ever heard. And the second person laughed at me because I used technical analysis, because that was the dumbest thing he'd ever heard. And that was the feedback I got from the market. I didn't know anyone else in finance, didn't know any traders. I was interested in Forex. So I went to the library, and then I went to the bookstore, because Amazon.com was an online bookstore, but it didn't sell anything else. And when I went to Amazon, it was a little online bookstore. No one really cared about Amazon back then. Typed in Forex, and all they had was Forex Made Easy. So I'm like, well, that's not a legitimate book. So anyway, so I went to the bookstore. I think it was Barnes & Noble. I got my latte and looked for books on Forex, and they didn't have any. So I really thought about it. I'm like, where am I going to get a book on Forex? And I thought, well, you know, bankers know about Forex, so where do bankers learn about Forex? And then I thought, well, maybe they learn at university. So I jump in my car and I zip over to Palo Alto to visit the bookstore, the university bookstore at Stanford University, probably the second best school in the United States. Anyway, so I go there and I buy a book. And of course, it doesn't cover technical analysis at all, and it talks about whatever, big picture stuff. So that's what I started with. There were no books. I didn't know anyone trading Forex, and my first trading platform didn't include charts at all. Isn't that neat? So what does it all mean, Basil? Well, I'm still here. I'm a survivor. Being an entrepreneur, I'm probably too stupid to quit, or was too stupid to quit. Right? So here I am. I survived. So, you know, this was what, 15 years ago that I'm talking about, right? Something like that. I don't know, maybe longer. So I've learned a few things along the way, and I am here to share them with you. Okay? And if you find them helpful, please give a little like, do the little thumbs up. Now, I have to thank the person that logged in 20 minutes before the webinar and gave a thumbs down. That's really, you know, some people are born with negative attitudes, but like that's taking it the extra mile, getting up early for the big old thumbs down stuff. So I appreciate the effort that you put in. If anyone else actually benefits from our 3 hours today, that's one easy way to, you know, show that your time is well spent with me. And then lastly, visit Traders Way and open a demo account. And give us an opportunity to earn your loyalty and respect there. All right. So good morning. Oh, I forgot to, in my history of me, forgot to mention I am a student at Harvard University. I am getting my master's degree in management. I was once given a case study about a company that was having problems with employee morale, and the whole class was discussing what to do and what they thought the right remedy for this. You know, so most people said, well, more transparency, or, you know, more of this or less of that. And they get to me and they're like, Wayne, what do you think we should do? Because I was unusually quiet. So anyways, I said, I think you should take all the employees, put them out in the field across the street from the factory, and you should execute one of the senior managers in front of all the employees. And my professor's jaw just dropped. So that's me. By the way, I got an A+ in that class because I had logical reasons for it. So anyways, let me remind you that trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, so please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Joseph says, good night in Australia. G'day, mate. Hey, Joseph, have you seen there's an Australian zombie series out on Netflix? I'm telling you. Yeah, there's some pretty good zombies in there. All right, very quickly, I think lots of people have attended these events over the last 12.5 years, so I'll be brief. This is straight out of my book, which was published 10 years ago, so I'm not trying to plug the book. But this comes from a business planning retreat that I had with myself at the beginning of my career. See, when I left my my VC job and started trading full time out of my home office, I did run into a bad stretch within a few months, and I really struggled. And it turned out I realized it had to do with just the isolation of trading all by myself. Right? So so I said, well, I got to get my act together. What would I do if this was some other type of company? And I said, well, I would take the senior managers out for a retreat, and we would talk it out, we'd feel it out, and then we'd write it out. And retreats are supposed to end with plans. Many don't, but that's what they're supposed to do. So anyways, I went on a business planning retreat with myself, and I'm telling you, it was probably the best weekend I had for my career ever. Okay? And some of the output from this was this credo, that the whole point of me trading was capital preservation. I realized if I lost money, I'm losing. Let's reverse this. I kind of thought in the beginning that the whole job of being a currency trader was make as much money as I could. But I had learned in the real world that there was something more important than making money, and that was not losing money. Okay? Ali, do your own due diligence. Okay. So anyways, I realized very quickly that if I ran out of money, that I'm not a Forex trader if I don't have any money, right? Or how about this? I realized if I did some math and some calculations and tried to figure out, what's an acceptable drawdown and all that kind of stuff. And that's where capital preservation came from. Because I realized in the math, if I lost half my account, I'd have to double the account just to get back to where I was. And doubling the account conservatively, right, is not an easy thing to do. So you don't want to put yourself in a situation where you have to double the account conservatively just to get back to broke, right? So I realized that the number one goal is actually capital preservation. And what that helped me do is filter through a lot of mediocre trades. So if I wasn't confident in the trade plan, then I would just skip it. And some of you might say, well, what's a trade plan? So we figured that out, right? The next thing is, once I'm into a trade, I need to manage the risk, and we do that through moving the stop. This has nothing to do with your target. This is only about managing your risk. So once I'm in a trade, I want to lock in a minimal acceptable performance for the trade. What that means is you move your stop to break even when you can, and then when you can, move your stop to protect a small profit. So that even if your mediocre trades collapse on you, you still, receive some sort of minimal acceptable performance. Think of it as, your quota if you were a salesperson, right? But then once I have that that map locked in, then now we're talking about the limit order. Where do you take profit? And that's where you try to make as much money as you possibly can. But not until you have a small profit locked in. Okay? So for example, if you actually bust out a spreadsheet and do some math, right? You will find that the only way to get filthy stinking rich in Forex, right, in the long run, is letting your winners run. Okay? That's the only way to do it. So that means you have to have good trade plans. That means you have to trade with the trend. The trends are typically set by fundamentals, and you need to let them in. You need to let them run. So another way of looking at it is, if you're making 15 to 25 or 30 pips per trade, you'll never get filthy stinking rich. Now that's okay if you're in it for income and you're picking up some pennies here and there. That's fine. And what that does is it pays for your losses. But I think you'll find that you're probably not much better than break even over a long period of time. So eventually what you're going to have to do is the trades that you got your good trades, right? Your good trades, instead of 30 pips, you should get 300. Okay. Okay, Joseph asks that something most educators won't answer. In terms of percentage, what is the normal percentage? Well, that's a very easy question, so I don't know why people wouldn't answer that, Joseph. Now, first of all, if you go to Barclays Hedge, you just have to Google that. Barclays Hedge manages reporting and returns, and I think an index of commodity trading advisors in the United States. These are professionals. You can basically call them hedge funds. They don't buy and sell stock. They buy and sell currencies or commodities, right? So just think of them like they're grain hedge funds or they're foreign exchange hedge funds, that kind of stuff, right? So this list of hedge fund managers, if you look at the global macro or the foreign currency CTA returns, and these are the guys that manage, like, they break them into two categories: 100 million assets under management or less, and 100 million assets under management, right, or more. And if you look at the returns of these professional traders trading these accounts, on average, they make 2% per month. Now, what you're looking for is 2% per month with low volatility. Okay? Now, you compound that over a year, that's actually a very, very nice return. Okay? But what's attractive is not the return, it's the low volatility plus the return. So when you're in a world of 2% inflation annually, but your hedge fund manager is making you 2% per month with low volatility, it's very, very nice. Yeah, well, Joseph, amateur traders that are producing, a typical amateur trader who thinks they're really good as a trader, they're doing like 25% returns per month, but they'll, right? But they'll also have 25% drawdowns, or worse, 50% drawdowns. And that's just not successful. You wouldn't be able to attract big money. So your assets under management will never attract professional institutional investors. Okay, so they're easy questions actually, so I don't know why people would avoid them. All right, so I hope you had time to take a look at the basic setup. What we're going to do today or now, well, yeah, let's go through a big rundown. I'll show you my technical my chart setup, and then a little bit later we'll go over the scalping techniques, but you should already have them, by the way. Okay, you should have already prepared for this event by coming here. And, oh, yeah, moderator, for some reason, I am not allowed to post in the chat room. So I can't post the link. So I was trying to post the link to the Non-Farm Payrolls, how to prepare for and trade the employment situation report. Okay. Wayne, should I stop? Hassan says, Wayne, should I have a stop loss to break even on an open position knowing that non-farm payrolls is coming up? Well, if you want to remove the risk, yeah. I don't know if you have 5 pips profit or 150 pips profit. But if you're worried about it, if you perceive in the market as a trader, if you perceive your risk is increasing, your job is to manage that risk. So moving a stop to remove risk sounds like a risk management technique, right? So if you're concerned, then you should do something, right? Hope's not a strategy. All right, so going back to this. All right, so I'll go over the chart setup. Then a little bit later, we'll go over the scalping technique, which has already been posted on FX Street. Here, I'll bring it down here. So I already wrote this out. Look how long this is. How to prepare for and trade non-farm payrolls, right? There's two different, there's the counter trend and the continuation, right? So anyways, that's all there. So you should go over that, but we'll go over the technique quickly. Then NFP is going to come out. So we'll trade that for a while. Then I'll start taking basically questions about technical analysis and fundamental analysis. And we can go through some charts. We could look at some longer term trades. And then around 9:30, we get the stock market open. Thank you, moderator. Well, it's not just links, moderator. I can't type anything. Let's see. Good morning. No, I'm blocked. Okay. So I can't type anything. So, but whatever, it shouldn't matter. Okay. So then at 9:30 the stock market opens, and then at 10 o'clock we have ISM services, and then at 10:30 we pull the plug. So again, I'll prepare you for the news release. Then we'll trade the news release. Then I'll field some questions between 9 and 10. 10 o'clock there's some more news, and then by 10:30 we're wrapped up. Okay, so that's kind of the agenda. I'm not sure if you get 3-hour webinars very often, so hopefully you take the opportunity to ask questions and get involved. Okay, Joseph asks another question. Sorry for asking too much, but one more important bitter fact is most brokers increase their spreads dramatically when it comes to NFP. Listen, okay, listen. It's the market, Joseph. Think about it this way. A high volatility event like the most important news event in the market, which is non-farm payrolls, if it comes out dramatically different from expectations, if it's terrible or if it's awesome, people have not planned for that. Imagine now that you have billions under management. And NFP comes out, and it comes out significantly different and is going to hurt your positions. You need to rebalance your portfolio, or you need to hedge your positions, or you need to get out of positions, or maybe it gives you an opportunity to get into other positions. But the thing is, you're now exposed to risk that you did not expect. So the market goes crazy after that news is released. Also, right before the news is released, market participants with billions under management realize, like, why would you put in new money right before a huge event that you don't know the outcome of? You're not going to, like, lose $45 million because you dropped a trade 5 minutes before non-farm payrolls. It's just stupid. So what happens in the full interbanking system is it freezes up. Nobody's trading except small retail amateur traders, right? But big institutional traders, they're not dumb enough to put big money in the market and bet on NFP, right? Or make a long-term investment and say, well, I'm just going to ignore NFP. NFP is the most obvious event risk, right, that there is. So big institutional traders just simply stop trading just before, or right? And then after, there could be a big wave of huge volatility. All of this stuff in the interbanking system changes the spread. Now, sure, many unscrupulous brokers might manipulate their spread further, but in general, the interbanking system, the spread between buyers and sellers, right, widens when there's less buyers and less sellers. The market is less liquid. Okay? Do you understand? So it's not someone like, no, let's just widen it to, to screw over a bunch of our clients. Now, what kind of business does that? Right? Now, there are brokers that probably do that. But understand how the market works. If you're trading and you're basically the only person trading, you're going to have to pay more for someone to take the opposite side. Okay? And that's why the spread, because you're reaching out farther, you're like, instead of someone trading right next to you, you have to trade way up here. Or just imagine a trading pit, right, where there's buyers and sellers, right? When the market's going crazy and the pit is packed, when you want to buy something, there's lots of willing sellers. And they compete with each other for lower prices. And you get a really, really good price, right? You're like, hey, I want to buy, I want to buy some wheat. And there's 100 people that want to sell you wheat. Well, you're going to buy the best price. And it's going to be the guy that gives you the lowest offer, right? So it's very competitive. There's very little spread between the bid and the ask. But what if nobody, right? What if no one's selling wheat? Finally, right? And you're like, I need to buy wheat now. I want to buy, right? And the guy's like, finally there's a guy on the other side of the room. He gets up and he's looking around. No one else is selling. He's like, yeah, I'll sell it to you. You're going to have to pay. Okay? That's the spread. There's a bigger spread. There's no competition on price discovery. So you're a price taker, not a price maker. Anyways, let's move on.com. Thank you for all the great questions, though, guys. Okay? Okay, we got to go quick, so make sure you pay attention. And by the way, thank you for the likes. Okay? So again, right now I'm going to go over the basic technical analysis setup so you understand my charts. Then a little bit later, a little bit closer to the news, I'll go over the scalping technique. But again, I published that 4 years ago. So you should already know that, but I'll go through it quickly. And then the news will come out. And then for about an hour, hour and a half, I'll field hundreds of questions from you guys, okay? So you're the boss. I'm just a humble currency trader. Okay? All right. So as mentioned in the previous slide, I measure speed and momentum of the market. I look at long-term trends and volatility. And then I look for overbought and oversold conditions. Pretty simple. Okay. This is the 2155 combination. What this shows me is the direction of the market. 21's below the 55, I'm bearish. If price is below the 21, I'm bearish and aggressive. If price is controlled by the 55, then I'm bearish and conservative. You get it? 21's in control, I'm bearish and aggressive. 55's in control, I'm bearish and conservative. To measure, let's describe it this way. If I'm a bear, I want to sell. If the market is bearish, it means it's falling, but there are certainly times when, even though the market is bearish, price is rising. Right? In a bearish market, the market is usually falling, but there are certainly times when it's rising. Does this depend on your time frame, Hassan? No. Whether it's a 1 minute or a 1 month chart, it doesn't matter. It's the same thing. Okay? So what I decided early on is I think it would be helpful if I had some way of saying, okay, technically speaking, this market is bearish. However, there are times in bearish markets that price is rising. So there must be a difference between the market and price. Okay? What pair is shown? Why does that matter, Ram? But anyways, I think it's USD Swiss franc from, I think I did this presentation 14 years ago, Ram, so it shouldn't matter. Okay, right? So anyways, if the market is falling and price is rising, I should probably look for opportunities where I'm selling in a falling market or I'm buying in a rising market. So I have to identify the direction of the market first. Then I have to recognize if the market's bearish, I have to recognize when the market is or price is rising so that I can get ready to sell when it falls again. You see what I mean? So I separated the market from price. This is the market, so I'm bearish. And then over here, this is price. This is a sell. This is a take profit. That's a sell. Okay. Over here, long-term trend. I call this the fair market value. If you get too far away from the fair market value, it tends to return back to the fair market value. So think of it this way. A bow and arrow, the more you pull right on the string, the more it wants to snap back. You understand the kinetic energy, or the potential energy, I should say? Okay? The centripetal, I'm talking about centripetal, not centrifugal force. I'm talking about the force of wanting to pull back, okay? So if the farther back you get away from the 200 EMA, the more it's going to want to come back. And I can explain why, okay? These are Bollinger Bands. They show you volatility. If you can also look at that as volume. They're not quite the same, but they're very similar. Okay? And then these are my oscillators. I slow the MACD down, and it shows me overbought and oversold conditions for the market. And I speed stochastics up to give me overbought and oversold conditions for price. So I use the 2155 EMA to discern the direction and speed of the market. And I use the MACD to show me overbought and oversold conditions for the market. I use the 5/8 moving averages to represent buying and taking profit price action. And I use stochastics for overbought and oversold conditions for price. So the stochastics and 5/8 for price, the 2155 and MACD for market. Do I use support and resistance? Well, you have to. So, okay, you can take all of this now. Okay, shut the door. You take that, you can throw all this in the garbage. I don't care what technique you use. I don't care what moving averages you use. I don't care if you use these oscillators or if you like RSI and CCI. Doesn't matter to me. The two most important things is your ability to identify support and resistance. Okay? And the second thing is for you to trade price action. If you don't understand price action, then you don't understand trends, you don't understand consolidation. And if you don't know where consolidation and reversals are going to happen, then you don't understand support and resistance. So if you don't know that kind of stuff, you're a cork in a sea with no current, no wind. Okay? So yeah. You know what? I'll go over the scalp situation now, and then we'll get ready for Trade the News, okay? Or to Trade the News. And we'll use tradethenews.com to get the numbers, okay? And by the way, if you want to follow those questions up, shut the door, like how to identify support and resistance and use price action, all that kind of stuff, after non-farm payrolls, like maybe in 45 minutes or something, we can go through that in great detail, okay? And same to the other 260 people watching. Yeah, I'm happy to answer your questions, okay? So we'll go through the scalping technique quickly, then we'll prep for the news, and then we'll trade the news. May I be so bold as to ask for a thumbs up, please? Would you do that for me now, please? Thank you. I just want to know if we're doing the right things in this event. All right. So first of all, non-farm payrolls is going to come out, and we're going to trade a 1-minute chart. Okay? 1-minute chart. I don't really know what the news is going to be because I don't know what the news is going to be. Nor do I know if it's good for a market or bad for a market. It's just a news event. It's not fundamental analysis. Okay? So what we'll do is we'll let the market decide whether it's good for them or bad for them. So the news will come out, and on a 1-minute chart, we'll watch it either go up or down. We'll either get green candles or red candles. Now, what our goal to do in this high volatility event-driven strategy is to either buy a dip or sell a rally based on the initial move. So in this example here, NFP in the first 3 minutes gives us some big green candles. So once we see the big green candles, you say to yourself, oh, I guess the market found it bullish. Cool. So if you're going to have a bullish trade, I don't care if you're on a 1-minute chart or a 1-day chart. You don't buy the market high. You buy the market low. You buy dips. You buy retracements. Okay? So in this case, if the market interprets non-farm payrolls as green candles, then what you want to do is look for a retracement. And you see this here represented by the red candle. You should also pay attention to where it found resistance, because this may be an important line in the future. Okay? So anyways, I may not be able to do this in the live event. I'll try to, but you need to do this on your own or just use your mind's eye. But what you want to do is look for a retracement somewhere between the 382 and 618 of the initial move. You also want to look left and see if this old resistance becomes support. So I would be thinking, as it falls from basically 48.90 down to 48.75, that I'd be a buyer somewhere in here. That's where I would expect to see a green candle. Now, you don't really get one. You might have bought it here. We don't really know. If you bought it around 75, your stop drops below here, below 50, so you're risking a maximum of 25 pips. In a high volatility event-driven strategy, you shouldn't be risking more than 25 pips. If you lose more than 25 pips on a scalp trade today, you're not following the rules of engagement and you're on your own. Right? You've been kicked out of the village and pushed out onto the ice floes all by yourself. You're out with the polar bears. Okay? However, it doesn't quite take off, and it actually makes a 786. And then the next candle is green, and then the next candle is, well, not lower low, and the next candle, once again, is not a lower low. So you might be actually long around the 60 to 70 mark, in which case your stop is just below 50. The stop is the same, but because of your entry being better, you're actually risking a little less. Okay. Now, this is a high volatility event-driven strategy. You'll notice that there's not a lot of time for group hugs and committee meetings. When you see the green candles, you need to say, I'm a bull. And then you say, I'm going to buy retracements. And once you get into your buy zone, or whenever you see the first whatever green candle or whatever you're looking for, you need to make that decision quickly and drop your stop. Right? Even if you say, well, if I buy it here, I'm only risking 15 pips, so that's what I'm going to do. I'm buying at the 786 or I'm buying at the 618 and I'm dropping a stop. I'm risking 20 pips. What's the big deal? And you give it a shot. Whatever. But once you get going, within the first 5 minutes, you should be able to move your stop to break even. Okay? You should be able to move your stop from just below this low to where your break even is. What you want to do is be at break even before you attack this line in the sand from earlier. So whatever resistance made this drop in the first place is going to be significant, or might be significant again in the future. So what could happen is that's the line, 48.88, in which this market could do a complete reversal, right? You understand? Where if this is going to turn bearish and make a lower low and spend the next hour falling, it's probably going to be near this line. That's why you should move your stop to break even and be hero or zero. And so as you approach here, you have no risk, and you either make money or you don't lose money. But at least you had the opportunity. You had a free look at the basket. You had a free shot at the net. You have an opportunity to win the game. You understand? So take the shot. In this example, it made money. In other examples, it'd just be a red candle and you get knocked out of break even. Who cares? Okay? And that's the general idea. Now, in the publication that the moderator posted earlier, I also give a counter trend trade that will happen probably an hour after non-farm payrolls, closer to the stock market open. And we can cover that obviously after the news comes out. Okay? Thank you for the likes, everybody. I appreciate that. All right. So now what we can do is we have 14 minutes, 13 and a half minutes until the news. Okay. We can go through what? I guess we should use Euro USD and just identify some key levels of support and resistance for that counter trend trade. Because the first trade I just explained to you is a scalp. And it's simply based on the market's interpretation to the news, the volatility. It's just a high volatility event-driven strategy. The event being the release of non-farm payrolls, and the opportunity being the volatility. And it has nothing to do with fundamentals. Okay? Now, the counter trend move is usually based off much bigger fundamentals, much bigger levels of support and resistance. And we can kind of do that now on Euro USD, because I imagine most of you trade Euro USD to some level. I know that because it's 40% of the entire Forex market. So just statistically speaking, right? All right. So this is, as they say, Betty, this is the Euro. And I've added some other indicators to this, if you were wondering. Okay? These lines that you see here, okay, they're weekly pivot points. Wait, my template's messed up. I must have clicked the wrong one. There we go. Wow, that was weird. All right, I clicked the wrong one. Okay, let's start over again. I'm adding some indicators. The lines that are thin, that go all the way across, okay, these are weekly pivot points. So at the beginning of this week, this was my projected low for this week, for euro dollar. I knew that Sunday night. Does that seem fairly accurate to you? On Sunday night, I said, yeah, that's going to be the low. 1530 is all I can really squeeze out of this market. Okay? So that's what these lines are telling me. So this is a pivot, this is a pivot, or sorry, weekly pivot, weekly pivot, weekly pivot, weekly pivot, weekly pivot, so on and so forth. The green zone being the take profit zone for bears. It's not necessarily a buy. Now, it's a buy in certain situations, and we don't need to go over it now, but this return to the central was actually obvious as well. So a bearish drop to this 1530 area was something we discussed on Monday for Traders Way clients. And when this hits a situation like this on a Tuesday or Wednesday, then I discussed with Traders Way clients that there's a propensity for this to move back to the weekly central, which is 1710. Oh, look. So Good trading week technically. Okay. Now, if I back out a little bit, or if you notice, how about that? I'll just scoot this in there. You may also notice, by the way, this is the projected high if you were a bull for the week, for this week. Okay. You may also notice some fat lines that don't go all the way across. There's a fat line here, fat line here, fat line here, so on and so forth. These are monthly pivot points, and they help me project highs and lows for the month. So I can now project a high and low for the month of June. Shouldn't come into play today, but I will use these levels. And in fact, what I'm going to do is I'm going to look at levels where weekly and monthly pivots overlap. So you see this top of the red zone? That's where weekly bulls are supposed to take profit. Okay? This gray area right next to it is actually a monthly pivot points where bears are supposed to sell. So to me, I look at this and say, well, weekly bulls are supposed to exit the market and monthly bears are supposed to enter the market. That could potentially be a huge sell zone. Bulls are getting out and bears are getting in. Maybe I throw down a trade. Now, maybe we don't get there today, well, or tomorrow, or this week, or maybe not at all in June. But it's fine. But if it did happen, then I know how I want to respond. I want to start looking for reversal patterns on small time frames, like a 15-minute chart or so, right? Okay. And so on and so forth. Okay. Same down here. This is weekly S2, monthly S1. There's a double cluster of support near between 1430 and 1418, right? So let's just say somewhere around 1425, there are likely to be, that's where bears would likely to take profit. So like, for example, let's say today was amazing and this sucker dropped down here today, post non-farm payrolls. It's not likely, but let's just say it happened. Okay? Inexperienced traders will say this will fall forever. An experienced trader will know that that's where bears will take profit and there will be a retracement, potentially a reversal. So you should just get out of your bearish trade and go to the bars with all your pips. Does that make sense? These are leading indicators that can help you anticipate entries and reversals before they formed. So you can, if you said down here, I think this is where bears are going to get out, and then you see a reversal pattern, that can give you permission to go long because now you expected a reversal pattern at that exact price because you expect bears to get out. So the market reverses from bearish to, at first, less bearish, and then maybe potentially bullish. So it's the fact that an hour ahead, a day ahead, a week ahead, you said, well, if the market falls down to here, I know to take my profit and look for a potential reversal. Okay? Anticipation. That's called trade planning. At the very least, it'll bring you confidence. If you're looking for a reversal pattern at an exact price, and then at that exact price you do get a reversal pattern, then you should be more confident in your trading. I hope that makes sense. Okay? And again, thank you for the thumbs up, guys. I appreciate it. So we're about 5 minutes now away from the news. We'll stick to the 1 minute chart. Okay, I'll leave this chart on even though it's a 1 minute chart because it'll have our pivots both weekly and monthly. Our week is basically over, so I don't know how important, because Monday we'll have new pivots, but we'll pay attention to that. Right now, we're most focused on the longer term pivots. Okay. Later on, we can also cover daily pivots if you want. Oh, and the other thing I should probably mention, on the 11th of June, I'm doing a 5-day workshop on how to day trade. And it's absolutely free for anyone that has a live account at tradersway.com. So it'll be the 11th, the 12th, the 13th, the 14th, and the 15th of June. It'll be available in the back office for live account holders. So, you know, I'll probably end up selling the course later on for, I don't know, $1,000 or something. But if you want it for free, you just need to be a live account holder at tradersway.com. So just visit there, open up, you know, apply for the account. And obviously it takes some time to open the account, right? You have to go through the due diligence and compliance and all that kind of stuff. So if you're interested in attending on the 11th, I would start today and submit your due diligence documentation and give compliance enough time to confirm your account. And then you're going to have to wire the money and all that kind of stuff. Okay. Yeah, I'll make it available, like, let's say for that 1 week, Rob. Okay. But anyway, so if you want to attend that, I'm doing it as a free benefit for live account holders. That's all. So thank you for being a client. Throw your diamonds in the sky. But again, you're going to need time to do that. So start now if you're interested. Again, it'll be about 5 hours worth of training, maybe a little more. Okay. So today we're going to use tradethenews.com to get the news quickly. Just want to let you know, they don't pay me money to do this. It's just a service I've been using for 14 years. I met them at the FXCM Expo. The one that had Larry Kudlow.
Fiat Chrysler saying they will be setting up a U.S.
And it was FX Street's first conference.
Santander move.
So FX Street had a booth, and it was interesting. But so, anyways, Trade the News. I was hanging out with them. I met them there, and I was hanging out with some FX boot campers, kind of next to the FXCM, or next to the Trade the News booth. And but we're having a private conversation, and we noticed some guy on the phone. And then he approached us or something based on what we were talking about. And we're like, so, you know, what did you know, and I forget how it happened, but he says, oh, well, I was just on the payphone. This is before cell phones, right? He's like, I just bought Forex Made Easy. It only cost me $5,000 or something. So we convinced him within about 10 minutes of discussion. He got back on the phone and canceled his order. And back then, Forex Made Easy, basically they were selling a MACD indicator for $5,000. Okay, we're going to watch the 1 minute chart, guys, as I have already explained earlier in the day, earlier in the webinar. So anyways, trading's risky, not appropriate for everyone. Don't risk money you cannot afford to lose. Past performance does not predict future results. Everything else I'm supposed to say. Thank you, FX Street, for hosting 146th time in a row.
A little more than 30 seconds. Non-farm payrolls expected at 190,000. The unemployment rate at 3.9%. We'll get the average hourly earnings data as possible.
It's the average hourly earnings that we care about, guys. We're at full employment. That number doesn't matter as much anymore. Okay.
10 seconds.
Here we go. Usani, I already explained what we're doing on Euro USD. If you missed it, your fault.
223,000.
Nice.
Significant beat.
223.
1/10 decline in the unemployment rate. 2.7% year over year. Wages 1/10 hotter than expected.
Oh, wage growth.
3%, also 1/10 hotter than expected. Average weekly hours 34.5, unchanged as expected. Back month was revised slightly lower.
All right. Small revision.
Manufacturing, we saw 18,000 print this month, and the back.
So this tells the market the Fed's going to continue raising interest rates.
That's a beat. The unemployment rate fell unexpectedly to 3.8%. The U6 fell to 7.6% from 7.8%. Again, wages hotter than expected at 2.7%.
So wages are good. Participation rate is good. Slight revision of last month, not bad. Slight increase in earnings, which is good. So it's a good one, right? This tells the market that the Fed is likely to continue to raise interest rates. And whatever path they're on, they're going to stay on. Some people thought maybe they were going to cool down their expectations. So it's generally good. Okay? So I'm only risking 20 pips. Remember, it's just a scalp. If I was swing trading, I would have a much larger stop loss. But in this case, it's just a scalp. I can always try again. But I'm not going to throw down a big stop on a scalp and hope it sticks. So if I lose 20 pips, I don't care. And if I get a better setup to the downside later, I'll take that. Okay? Because I don't really want to be bullish yet. The reason for that is we're still not making higher highs. So I still have a tendency to be a bear. Plus, if I wanted to be a bull, I'd be a bull closer to this level or this level, right? So those are buying levels. So I don't really want to buy up here. So I'll take the sell. I'm only risking 20 pips. I'm following the rules of engagement on the high volatility event-driven strategy. And if I want to be a bull, it'd be down here and down here. So I got time. It's just a scalp. Okay. So let's take a look. I just want to flip this over now and take a look at daily pivots. Deo, listen to what I say. Who? Yeah, that's the daily support pivot. Shouldn't be that big of a deal. So it's made 100% retracement now. So the market has flipped. It's not favorable to my position. Now, the reason it's not favorable to my position is our event-driven strategy is based on something like this, right? Continuation. What we don't know is we know it's going to retrace. We don't know if it's going to retrace that high and fall. That's less ideal. What just happened is basically a double topped. Again, not ideal, but that's why it's a scalp. Does that make sense? So it's just the rules of engagement. If you're going to try a high volatility event-driven strategy, it's a continuation pattern that you're trading. So if it makes a higher high, it's not really supposed to be there, and that's not good for us. Okay. But what are you going to do, huh? What are you going to do? So we're stuck in here, and this is, it ends up making things pretty lame today, because look what held up the market. That is what held up the market. That's lame, isn't it? That, what is that, daily support? I mean, it's nothing, right? So if I want to stay a bear for all the reasons I just explained, because it's not a bullish buy here, okay? That's not a great place to buy. So if I lose money on this first trade, my next one that I'm going to set up is a sell off the top here. Okay? But that's now based on a weekly pivot. Okay? And therefore, that's going to change my expectation. It's not going to be a scalp anymore. Okay? If I sell up there around 70, then my target is going to be down here, 15. Okay? So it's no longer a scalp, but it's a swing. I'd probably be short until Tuesday or Wednesday. Okay? If that doesn't make sense, please ask a question. This is a scalp, high volatility event driven strategy. Okay, that probably only gets me down to here. So I'll only make 70 pips or something. I'll get out at 16. Okay? So, right, let's put it this way. The high volatility event driven strategy, my target is 16-ish. So I pick up 50, 60, 70 pips. Okay? If it goes up to here, I have to get compensated. And it's no longer a scalp. The scalp is the high volatility event driven strategy. If it flips on me, it ain't my fault. Okay? I mean, that's actually really lame that we got a decent NFP and we can't even break this. NFP used to move 300 pips in a second. Now we can't even move 30 pips, right? So anyways, if it heads back up, it's not a scalp anymore, and I have to get paid more. It's a bigger trade. It's not the same trade. So if I sell up here around 1720, 1730, then I'm not going for 16, I'm going for 15. And the market owes me 250 pips. Okay? Oh, snap. That is lame. How lame. That's a lame NFP. Holy smokes, eh? Oh, for sure. Wow. Boo. So we got the drop. I sold the 618. That ain't a bad trade. I'll do that again and again and again. Oops. So why would the market flip on us? Let's see. Higher wage growth. That means what? Higher wages. Well, if the marginal propensity to consume is constant, but you make more money, then the amount of money you make and save increases, which then increases prices, which then what? Increases inflation, which then the Fed raises interest rates. So that's good. Unemployment fell further, which means even more people are working. Okay? Labor force participation rate. All of that really says the Fed should continue to raise interest rates, right? So Hassan says, if the news is so good, why is it? Oh, that's what, right? We're trying to figure that out. Now, the figuring it out is, it seems like that was essentially priced in. Okay? And the market's okay with that, or like I've done here, you trade it like a range. Now, range trading, as you probably know, requires something like this. How should I do it? Let's say to the downside, it breaks down. So then you sell the retracement back at the roll reversal, or you let it break out to the upside, in which case you wait for a retracement and you buy. Okay? Both of those are trend trades. If you're going to consolidate, let's say, if you're just doing pure range trading, instead, if you notice that this is starting to fall, you sell here. And your target is the support. Okay? Because we don't know if it's going to break out. In fact, I assume it's going to stay in the range until it does break out. So you could just sit here and do nothing until it does break out one way or the other. You don't even really care. And then you wait for the pullback and you sell. If you are trading the range, then price may come down, hit the support, and bounce and head back up, in which case you could buy. Okay? What's most important is the prices. Okay? If you come down here and you start to see a little green candle on let's say, a 5-minute chart or whatever, and you say to yourself, oh, support is holding, then you would buy it, and your target is going to be the top of the range. If it goes to the top of the range and then you start to see red candles on a 5-minute chart, you can say, oh, resistance is holding. You could sell it with a target of support. And keep doing that over and over and over again until that doesn't work and you do get a breakout. It does go higher or it does go lower, and you say, oh, there's a breakout. I know how to trade a breakout. And you wait for the retracement, and you do that. Okay. Yeah, Nice T says, it's just proof that trading the news is very unpredictable no matter what the results. Well, yes, in fact, right? So scalping the news shouldn't be a ginormous part of your trading career because there's more risk involved. And these days, the market's so mature, like this is the norm now. But when I first started doing this event 146 months ago, we would have moved 1,000 pips already. Did you know that? It would have dropped 300 or 400 pips in the first 1 minute. And then retraced all of it, maybe even more. It could have dropped 300 and then risen 500 and then dropped 200, all in the first 20 minutes. Okay? So the market is much more liquid and mature now. Okay? And what tends to work better is trading in the trend, for example. Swing trading is a lot better than scalping. So imagine when I first started, it must have been much more like Bitcoin, where Bitcoin can move 20% in a day. 20% in a day, 20% in a year would be bad, right? It's not high-frequency traders, in my humble opinion, Wes. It's just more traders. The market's more mature. There are more people buying and selling. Prices are more stable. This is a good thing. But like there was a day when, you know, I used to teach people how to scalp 100 pips at a time. Now you're probably scalping 10 or 20 pips at a time. I used to teach 100, right? Well, now it doesn't move 100 pips in a day, right? Yet alone an hour. You know, there were times when I would make 1,000 pips on pound yen per day. Back when I was teaching FX Bootcamp, you know, we used to kind of celebrate people's first 1,000 pip trades. And you're like, oh, Barry got his first 1,000 pip trade. How does it feel, Barry? And you're like, best week ever. Woohoo! All right? So that has changed. But those moves are still there. They can be smoother. They take a little bit longer. But that also means you can plan more. But this idea that you can scalp and buy your yellow Lamborghini is just fool's gold. You know? Just fool's gold. So I propose I hope you don't mind me eating. I propose you learn how to scalp. I propose you learn how to spot trade. I propose you learn how to swing trade. And I propose you learn how to carry trade. How's that smell? What do you think? Okay? So we can still scalp this, by the way. But because we're in a range, I don't really want to do anything till we're up here. And I already highlighted that before the news came out. Okay. So I want to take a different point of view here. If I was a long-term bull, I want to buy it at 16. Okay. Yeah. Pro Capital says it stopped around daily central pivot. Well, it started at the weekly pivot. So again, it's your call on what's going on. If you're short up here, your trade plan should have been this. Okay. So as a bull now, again, I've already highlighted this, but let's do it again. If I'm a bull, I'm expecting bears to take their profit here, or, and maybe even more likely, definitely they'll get out here. So now as a bull, I want to have bullish trade plans based on buying those dips. Okay. So as a bear now, what I want to do on a smaller time frame, let's get rid of that. Boy, that sucks. Anyways, now the next trade plan is this. Okay. So you can still scalp this, guys. You're just doing it in the middle of a range, but look, you have the roll reversal, right? Let me try to scoop that in there. You have permission if you want to do it. Okay. And if you trade that, it's no longer the high volatility event driven strategy. That's already been miffed. That is a weekly swing. Now you're doing it on a Friday, so you're wicked late. But I would say your conservative target is 16, but the target you're supposed to be aiming is down there. But that's really something you're supposed to get on Monday, not Friday. Okay? Now, if I was in this situation on Monday, that would have been the trade. Okay? How long have I been trading? I think it was 2004, 2002. Not really sure. Okay, is anyone doing this one? You tell me, should we put another trade on this or what? You got to hurry up. It's already kicked off the 618. Should we put another trade on this, yes or no? Still in the original scalp and stuff like that. Yeah, that's better. Yeah, the retake is way up here, but I feel like we should be watching this together as a group. That's a problem with talking through webinars. Okay, let's do a quick look around the world. Let's put everybody hourly. 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 And I'm missing somebody, huh? 1, 2, 3, 4, 5. All right. So check this out now. Initial response, dollar strength. 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 Okay. Going over to this, let's check some commodities. So again, guys, if you're just attending, would you please give a little thumbs up? It helps FX Street. It shows that this is valuable content. Would you please do that? I appreciate it. It takes you nothing. I'm doing a 3-hour webinar. I'm asking you to spend a third of a second clicking that. Appreciate it. Okay. Yeah, well, Barry, you have to understand why, though. Some market participants are changing their portfolio, they're rebalancing their portfolio, and that gives an opportunity for other people to add into their portfolio. So some people are getting out, and then it goes up, and then other people then sell the new lower high, so they're re-entering their trade. So some people are building up their positions, while other people are scaling back their positions, right? So that's why it goes one way for a bit and then the other. Okay, so anyways, this is gold. Not sure if you trade gold. Are there any gold bugs out there? Okay, so this has been range bound for a week, looks like. So we got a first move breakout. And that corresponds with the dollar strength of non-farm payrolls. Okay. Question is, how long will that last? The next buying for gold is down around 1284. Okay. But I highlighted that 2 weeks ago. Okay. So there's just a big giant sideways. That's all. Big giant sideways. So if you go out to like a 4-hour, we're stuck in there. But you can see it's much more bearish than bullish. Maybe you can highlight it this way. Oops, I guess it wants to do that. Okay. You might want to highlight it that way. What's interesting is if you're a gold bear, your target for June is 1268 conservative target. Aggressive target is 12.58. That's where you're going. Okay? So that's another $40 drop in gold if you're trading that. Now you can see I've highlighted that price already for a different reason, and it's this old support and resistance. Okay? So that tends to make sense. Now I drew this support and resistance like 2 months ago. So now that's the June target. If you're a bear, you're going to find that irresistible. Okay? Okay? Awesome, right? Throw your diamonds in the sky. Throw your diamonds in the sky. Ooh, 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 ooh. Let's take a look at oil's reaction. Not a lot. Okay. So if you're still bearish on oil, the technical plan for Friday would have been to sell it around what is that, 67 67.50. Okay, somewhere between 67 and 67.50 would have been the trade plan to sell. And your target, depending on the time frame you're using, is either 65, but 63 is better. Maybe even 62 if you're really aggressive. So we'll say 62. So your trade plan would have been this earlier today. Now, non-farm payrolls always messes things up. But let's say in a normal situation without that event risk. Okay? That would have been sort of the plan. Okay? And to do that, I'm using a combination of weekly and monthly pivots. Okay? Now, another way to use it is if we end today lower on oil down here, then what you're going to use is on Monday, you're going to sell a retracement back to our 21 EMA. So I got to zoom in here. So use the 21 EMA. Where's that 21 EMA going to be on Monday? Okay. Now, first of all, let's say that looks like trend. Okay, that's better. But also remember, because it's moving right, but it's also moving down. Okay? So let's say we continue the velocity, but at the very least, it'll be pointing more down. So let's say, I'm trying to catch this a little better. So let's say Monday is more like this, to the right and lower. So if that's the case, and you're trying to be in this bigger trade down to, what did I say, 62, then your trade plan on Monday, now you have to listen, if we're down here today, at London close or New York close, if our low of the week is down near this green zone, then Monday you're going to look for a retracement back into the future 4-hour 21, which I am anticipating going to be somewhere around there, right? So therefore, you want to start selling about there next week on Monday. Does that make sense? Next week's pivot, pro capital gain. Cool. Now, what if you're a bull? Okay, if you're a bull, You're in the buy zone right now. My trade plan as a bull is this. Okay? Now, if that doesn't work, my plan B is to let it fall down to here and then buy it at that price. But my expectation, because of that lower low, needs to be adjusted. I can't expect a higher high after a lower low. So my expectations are going to be more like this. So if it falls to 64 and I buy it around 64, my target's going to be 70. Okay? If I double bottom, then that's a reversal pattern. So this bearish move would be over. Okay? So I'd be buying around monthly M2, weekly M2, and my target is going to be 75. Any questions? Eternal Soul, I don't think people care about the PMI. I think ISM Services matters at 10, but that's probably what you're talking about. But yeah, the ISM Services, they'll be important. I remember in 2007? No, that's the year I was at the FX Street Conference. 2006? 2008? Maybe it's 2008. Back in 2008, maybe, I did a panel discussion with Ashraf, Lottie, and oh, what's the guy's name? The guy that used to work at Forex.com. He's on CNBC now. What's his name? Gordon? No. What's his name? Todd Gordon. So Todd and Ashraf and I were in a panel discussion in New York, and we were discussing how interesting at that time, just in that kind of period, ISM Services was creating more volatility than non-farm payrolls. And that was the first time. That was the first time that happened. So NFP had changed from moving 300 pips in a minute to moving maybe 100 pips after non-farm payrolls, right? And ISM Services was a bigger deal. And that was a very interesting conversation. And by the way, I thought it was a very cool panel discussion. There was one other dude from some other broker that nobody knows of. But it was very interesting because Ashraf is super smart and alpha male, right? And Todd Gordon's super smart. I've spoken with both those gentlemen probably 5 times, I'm guessing. All right. And then I'm not that bad, but I'm also an alpha male. We're all alpha males, right? And here's this other guy who was just super quiet. I think he was very analytical or something. And the 3 of us were just overpowered this guy. And it was just funny. It was a great panel discussion just because we had such big personalities, and those, you know, Todd and Ashraf are smart. They're smart dogs, man. They're good. Top dog. So anyways, but that's when ISM really had taken over. And then sort of NFP worked its way back. But notice now that even with a decent non-farm payrolls, what did we move? 30 pips? 30? Not 300, right? So maybe it moves 50 for the day. Like, that's weird. So things have really changed over the years, but that means you should have a stronger understanding of fundamentals, and you should focus on staying in trends. Okay? Now, my target for oil since, I think, February was $73. Is anyone, now I think there's quite a delay in the conversation here, but is anyone in the room, can anyone in the chat room here confirm that for the last 6 or 7 or 8 or 9 weeks or whatever it was, that our target was $73? Can anyone confirm that? And while that happens, the interesting part, of course, is it hit 73 and did this. So where do you buy it back if you're still a bull? Because remember, if you're buying oil, you're buying an improving macroeconomic condition. Okay? So where's the support? So check out where these trade plans are. The first one is here. And ask yourself, could that possibly be our support? Yeah, Todd Gordon is an Elliott Wave guy. Yeah. I don't use Elliott Wave. I just, but I think if you were an Elliott Wave technician and you traded with me for a while, you'd say, oh, Wayne, you use a lot of Elliott Wave stuff. Well, if you're trend trading or using Fibonacci studies and stuff like that, yeah, well, that's a lot of what, what Elliott Wave is. I just don't like count waves. And the reason for that is it just doesn't fit my personality. I'm an entrepreneur. If you give me rules, I just naturally want to break them. I don't even know why. I'm like, what? You have rules? Screw your rules, right? And I'll just find a way to do it differently. So I just don't have the personality type of, this is a C correction of a 2 wave and all this. It's not me, man. But for certain personalities, it probably works well. And Todd is, I remember one time sitting on a panel with him. I think it was a Futures Magazine panel discussion in Vegas. Again, probably 10, 12 years ago. And, I remember him. He was dressed like a businessman, right? He was dressed like an accountant. I don't think he had a jacket on, but I think he had a business suit on with a tie. And he had a pen, and I remember clicking on his pen, and then he put his pen in his pocket. Like, he looked like a proper adult, right? He looked like my attorney, right? He was smooth, good looking. He knew he dressed well. He knew what he was talking about. But he had that personality where, like, that he would follow the rules. Right? That he would say, well, I'm coming up on there's going to be a 3-wave correction here and I will follow these rules and all that kind of stuff. And I think it fit his personality. I don't know him that well, right? But he comes across this very, very professional, like maybe a New York banker, New York attorney, New York whatever, right? Whatever it is. And so I think that follows the personality. Now, I'm more of like the entrepreneur. I'm like Silicon Valley, I worked at Apple when it was, I owned Apple stock at $6. When I left Apple, I worked at Cisco Systems. When there was 3 buildings, I got hired at Cisco when they just got out of their trailers. When Netscape left their Mountain View trailers, Cisco Systems moved into the trailers that Netscape used to have. And then they outgrew the trailers. So then they started building buildings in San Jose. When I worked at Cisco Systems, John Chambers walked by my cube and introduced himself and gave me some candy. He's like, welcome to Cisco. So I'm not really like the New York lawyer, banker kind of guy. I'm much more entrepreneurial, and therefore I don't fit, my personality doesn't fit tight rules like that. But if you added it all up, you looked at what I do and you looked at what Elliott Wave suggests, I bet you a lot of what we do is very, very similar. All right? So you just have to find what works well for you and your personality, because you need to do it over and over and over and over and over and over and over again, and that's what makes you successful. Being able to outsmart the market is not what you're supposed to be doing. What you're supposed to be doing is figuring out the market. So what is really, really important, more than three-wave corrections of CU moves or whatever, I think is simply having your own rules of engagement, in particular having a fundamental bias or long-term technical bias. So if you use a daily chart instead of fundamentals, whatever. But you say to yourself, I am a bull. 90% of your work is done. If you're losing money or you're very inconsistent, it's because you probably trade very inconsistently. You don't have a bias. You have no idea what you're doing. You're a bull today, you're a bear tomorrow, and then Thursday, well, I don't know what's going on Thursday. We'll see then. That's why you're inconsistent, because your trading is inconsistent, so your results are going to be inconsistent. So if you instead say, I'm a bull, then you say, okay, I am going to use technical analysis to identify the next two areas, in this case price, the next two prices that I will consider buying. So how do you decide that? Well, that's why we invented technical analysis. Just simply to time your entries. You don't need a chart to say you're bullish on oil, right? I can give you lots of reasons why, if you want to buy oil, why you should buy oil. I don't need a chart. It has nothing to do with time and price per se. Supply and demand is way more important than price, okay? So anyways, price has been falling for a couple of weeks. Great opportunity to buy. Because globally, maybe nothing's changed, right? So now I can open a chart and then say, oh, based on technical analysis, what prices would I be interested in buying? And I start doing this and I say, well, it could look interesting around 66.5 or 66. Let's say so around 66. And the next level I'll consider is more like 65, really. So once we're down there, I could open like a 15-minute chart and look for a reversal pattern. Is this a reversal pattern? Not quite, but maybe. Maybe it's forming. What if it did this over the next hour? Now what? Yeah, I could buy somewhere in here. And then I'm done. Now, right? I just simply am anticipating a bigger move, a higher low, right? I buy the higher low. I put my stop there. I'm risking 50 cents, right? And off I go to the races, but I'm risking 50 cents, right? But I'm going for, I'm going for that much, clearly more than 50 cents. Now, how did I come up with this? Well, it's technical analysis, okay? I can throw down something like this, okay? And we could call that a 50% if you want. 50% predicts a 1382. Okay. So actually, Elliott Wave would say, you know what, Wayne, if you bought it at a 50% retracement, it'll probably go as high as 78.70. So let's just say 79. Okay. So if I bought it at 66, I should be going for 79. My pivots tell me it will probably not happen in June. It might take all the way to July to achieve that price, but whatever. Okay. You see how you fold all that in? Look at this, bouncing at support again. Still stuck in the range on that stupid euro. How boring. Yeah, how boring. What a boring trade. So anyways, that's interesting, right? What should we do? What should we do? It's funny I have WTI twice. Oh, because one of these was Brent yesterday. Okay. One of the things we were talking about yesterday, if Brent and WTI go up, right? USD CAD or USD NOKI should fall. What do you think? Okay. If you're a bull, this is a buying opportunity. That means dollar strength and NOKI weakness. That means you probably want oil to fall and the dollar to gain strength at the same time. Hey, our next non-farm payrolls, I'm going to do from Harvard. In July. July! You guys want to come to Harvard University? First Friday of July? Barry. Pig dog. Thank you, Barry. Igor. Yeah. You know, the world is a funny place where you get cut down because you went to Harvard. Like, yeah, I think you're stretching. Let me tell you, so I'm old, right? I'm in my mid-40s. It's interesting going to school with 20-year-olds. These Harvard kids are wicked smart, like holy schmoly. They're smart kids. They're actually fairly humble, but they know they're smart because they've been smarter than anyone else they've ever met their entire life, since elementary school, right? They're just smarter than everybody else. And they're driven, so they're like, I earned it. I go to Harvard and I'm awesome. And they are. Like, it's really amazing. Right? And often I look around and I'm like, how'd they screw up and let me in? Like, why am I here? I was on campus for, I didn't know this, but I'm like, hey, I'm going to attend class. I don't always attend live, or I mean in person. You know, obviously I attend mostly online, but I like to show up to class when I can. So one day I'm like, I'll zip out to Boston, right? So boom, I walk into class. I walk down into the classroom, and I'm like, wow, there's a bunch of old people here. I'm like, cool, I'm not the only old person, right? Right? It turns out it's bring your parents to school day. And I'm the same age or even older than some of the parents. And I'm like, oh no, it's bring your daddy to school day. And yeah. So it's just, it's a weird thing. But let me tell you, if you get a chance, you should do it. If you get a chance, you're never too old to learn. And I love learning. But holy smokes, those kids are smart. Okay, so let's take a look on Piggy. Okay, is this a good place to sell? Yes or no? No. So that may be an opportunity for a bull. Also, you should look left. Bring it across. There's this. And there's this. And who knows? There's this. Okay? Those are areas of resistance if you're a bull, but there are also areas of resistance if you're a bear. Okay? So, if you're still ultra aggressive bear, okay, move your chart to 4 hour. Is that really? That's not the 4 hour, right? Hour, 4 hour. Oh, well, we're already out of that position. All right, cool. Go back to the day chart here. All right. So if you're a bear, you should look to sell. Your first opportunity is 134.23-ish. Okay. That predicts 128.55. Your next opportunity is actually going to be significantly higher, 136.50-ish. If you sell at 136.50-ish, your target is only 130.74. Your third opportunity to sell would be 138.17, and your target would be 134.23. And for that to happen, you'll probably need to get to 138 in the next 10 days. Carlos says he's 29, feels old at school. Yeah, I'm the same age as the professors. It's crazy. They teach the financial crisis like it's in textbooks. I'm like, that just happened. I was there every minute. I'm like, I'm in the history books, guys. Right? My last class, we're talking about mortgage-backed securities, asset-backed securities, collateralized debt obligations. I'm like, oh my God, you're killing me. This is awesome. Right? So we had to on my final examination, we had to discuss different tranching strategies for collateralized debt obligations versus asset-backed securities versus mortgage-backed securities. You know, how do you create a AAA instrument out of B and C bonds and stuff? It was pretty interesting. Okay. All right. So someone is asking basically for pound dollar now. They want a shorter term strategy. Well, can you really have a proper shorter term strategy without knowing the longer term strategy? Not a good one. Okay. By the way, the stock market's opening in 6.5 minutes. And then we have one more hour. At the top of the hour, so at 10 a.m. New York time, we also have ISM services. So again, if you have questions, we're down to basically the last 30 minutes of Q&A. So make sure you ask whatever you need to ask. Okay? So that's the longer term stuff. Now, what if okay, how do you interpret this on the shorter term? Let me try to move this. Well, if you thought it was going up to, let's say, 136.48, this was you thought it was going to do this and then do this. Okay? Now that's on a daily chart. That could take a week and then 2 weeks down. That could be 1 week up, 2 weeks down. So what about the smaller time frame stuff? Well, on an hourly chart, remember on an hourly chart, there's 24 candles just to get here. So you need about 48 to 50, right? Let's say 50 candles to get from here to here, minimum. So on the smaller time frame, as it's going up, you're going to get opportunities to buy dips enjoy higher highs and buy dips. Okay, so on and so forth. So you kind of get a move like this. What would Elliott Wave call that? What would Mr. Elliott call that if it looked something like this? Probably a three-wave correction or whatever, right? So that's why it works. What I'm suggesting is on the high time frame, it could go up for a while and then fall. So bulls know that they can buy it, but they should be cautious and take some profit here. And if they keep going, they should do the same here. And that they're vulnerable to a complete collapse. Even if it went up for a week, this thing could do a complete collapse. You understand? So now you have to fold this into your smaller time frames and say, okay, I could be short-term long, but long-term short. Do you understand that this is the exact price I would recommend buying pound dollar for the month of June? Doesn't mean it's going up. I'm just telling you that's the right price to consider buying if you're a bull. Doesn't mean it's going to go up. It's just the right price. And does that mean it's going to go up forever? No, it's a downtrend currently. So you should identify your levels of risk, aka take some profit here because it might totally collapse and make a lower low. Because we know it just might go this far and drop, right? I've already described that. But it could go this high, right? And then drop. So if you're lucky enough to be a bull and you're up there, take some profit. Okay. The third scenario is if we hit this early. Remember I said 10 days? So what if a week from now we're up, pound dollar's up near 138? I would actually start to sell this. And I'd probably be short the rest of June and all of July. Neat, right? Hey-oh. Need some fresh air, man. Holy smokes. It's getting warm in here. Problem is, it's that time of year where if I open my window, it'd become 90% humidity. So hopefully looking at it this way is helpful. Let me zoom in. This is a bullish buy zone. Okay. Do you see what's interesting about this price, 134.31? It's a monthly central, but it's also next week's aggressive high. See what? If you bought here, you're buying next week's bullish entry. So you're trading next week's pivots, even though they haven't occurred yet. I front run next week's pivots. I'm often trading next week's pivots this week. I know. It's a burden. I was born this way. And that means I start on Friday and I'm looking at next week's aggressive target. So that gets me to 34.32. But at 34.31, no, sorry, at 34.23, we have the monthly central. And I know bears that are bearish, they want to sell here or here. Well, if bulls are taking profit as they should, why won't it let me go in? There we go. So if bulls buy it here and they work their way up Monday and Tuesday, and we find ourselves, let's say Tuesday, at 34.32, they're supposed to take profit. That's what a conservative, disciplined weekly swing trader would do. in particular if it's Monday, Tuesday, or Wednesday. That being said, if the bulls are going to exit the positions, oh, did I miss it? Sorry, guys. Thanks for the heads up, eh? No, wait. It doesn't come out till 10, bro. Getting all excited. All right. So if conservative disciplined bulls are taking profit around here, then that leaves a vacuum for bears to fill. Okay? And do you think there would be bears in this market, guys? Yes. So my analysis, Wayne McDonell of TradersWay.com, my analysis of pound dollar is it has a likelihood of rising Friday, Monday, and Tuesday. Up until, I'm going to have to use a 4-hour, up until about 134.31. In which case, bulls will exit and bears will take over, and it's going to drop like a ton of bricks. So the rest of next week will become bearish, and maybe even the week after that. Okay? I don't know if that's going to happen, but that's what technical analysis is suggesting could happen. So that's an if-then statement. So if it continues to go up, you have permission to buy it on the short term. Then, if it hits that pivot target early next week, then you have the permission to take all your profit, flip and reverse, and sell for a week or two down. Short term up, long term down. Okay? Hey-oh. Yeah, I like oil. Okay? Okay, so if I like oil, would you connect this bottom, with that bottom, with that bottom, with that bottom, and call this a potential bottom? Let me connect those other two. There we go. Okay. Is that a good place to sell? Nick, I already explained it when I did it, right? It's either going to fall or it's not going to fall. Okay. Chris, that happens at 10. It's 9:30. The stock market opened. Okay. So guys, if you think that's support, it's a horrible place to sell. However, if it turns bullish here, it's important for two reasons. One, you're buying at support. The second thing is that support is a pivot. Not just any pivot. There's lots of pivots, but this is an important pivot. That one puts you in the trade for up to a month. You know what I mean? You don't have an entry yet. If you happen to already be a bull, then the next month is going to look like this to you. Okay? We'll leave it at that. If you're a bull, that's what you're thinking. Okay? If you're a bear, you already sold this at 68.50. Okay? So you wouldn't sell here if you're a bear. You'd be foolish. Absolutely ridiculously foolish. Selling this is just like, yeah, I mean, isn't that what you're supposed to do? Right? So it's just as obvious as that being a sell. This is just as obvious as not being a sell. Does that mean you should buy it? No. It means you just can't sell it here. Oh, sorry, this is WTI. This one doesn't have the watermark. Let me change it. Okay? But it really doesn't matter what pivot it is. Okay? But anyways. Okay? So just wait it out. If you find yourself looking at green candles 2 hours from now, it might be a buy for you. What is the account size to handle the market long-term buy-sell? Well, right? So you need to trade the smallest trades you possibly can. So $1 in oil for a standard contract is $1,000. And if you lose $1 in oil, it shouldn't be a big deal. So your account size should be, let's say, if it was $100,000 and you lost $1 in oil, that's equal to 1% of your account. That's not a good month, but that's a month you can recover from. If it was 10% of your account, that's a horrible, horrible, horrible month. So, right? I have a feeling you don't have $100,000, right? So that's really a personal question. You can look at the math and say, well, maybe I need to trade minis or micros or something, okay? So I'd like to reverse engineer it, Jeannie. Notice how I answered your question. I didn't answer your question by how much money you make, but how much loss is acceptable to you. Right? So if you lost $1,000, but you had $1 million in the account, that's 0.001%. And you're like, well, that's no big deal at all. But if you had 5,000 in your account and you lost $1,000, holy crap, that would be horrific. Okay, see what I mean? So just reverse engineer it. What is an acceptable loss? Percentage-wise. And then from that, you know how much money in your account. What does that have to do with anything, Igor? Right? One standard lot is $1,000 per dollar. So, anyway. No. So, you're just simply wrong, Igor. You can tell yourself whatever you want, but you will never become a professional trader with that kind of volatility. So, no, you're wrong. All right, we can look at some yen pairs. So let's go back to what someone else asked me, what kind of returns do professional traders get? And I answered, well, if you look at the Barclays Hedge Index, professional traders with less than 100 million and more than 100 million essentially average 2% per month. That is the best. Okay, you see what I mean? The best traders earn 2% a month. Most of the people in this room, in this chat room, are probably going for 20 or 30 or 40 or 50% per month. So you're taking on 10 times the risk of a professional that's been trading for 20 years, let's say. And you're accepting volatility with that risk, in which institutional investors clearly are not accepting. So look at what those professional hedge fund managers are doing in the macroeconomic space or in the foreign currency space. If 2% is their average month, then do these guys have 10% drawdowns? No, they don't. So if you want someone to mimic, you don't have to mimic me, but mimic like what a professional industry is doing. So what, Igor? Right? So what? So you think because you're poor, you should take on more risk? But maybe that attitude makes you poor. Shouldn't you be trading exactly the same as the professional with 100 million? You have 10,000. Some guy has 100 million, but you should be trading crazy and he should be trading conservative? That's ridiculous. So why don't you develop a track record of success over the next 3 years? You're like, Wayne, 3 years, I don't want to commit to conservative disciplined trading for 3 years. Forget it. I want to get rich now. Then just by definition of your logic, you're not going to make it. But let's say you're willing to work really hard for 3 years, day and night, and make sacrifices. Kind of like going to Harvard when you're 45. Signing up for a 4-year program. Well, I'm a currency trader. 4 years is nothing, right? So anyways, so you say to yourself, for the next 3 or 4 years, I'm going to trade very conservatively, very disciplined. I'm going to risk hardly any because I want consistent returns and low volatility. If I can do that for 3 or 4 years, then I can show that to wealthier people who do have disposable income for investing, and you can show them an income stream that they essentially can count on. And they say, oh, well, here's some money, and now you're over your poverty problems. You know what I mean? Well, yeah. Well, can we ignore Igor? No, but he brings up an okay point. I mean, so put it this way. Look at your trading with a long-term point of view and have low volatilities, consistent returns, and then increase your assets under management 3 or 4 years from now by starting your own hedge fund or managed program or whatever. And now trade, let's say, $1 million assets under management instead of $10,000 assets under management. And, now you're earning 2% a month. What does that add up to be? 40% a year. So now you make $400,000 a year for your client. You charge your client what? 30%? 20%? So you're charging your client about $100,000 a year per million. Well, that ain't bad. So you do that for 3 or 4 years and get yourself 10 million under management. Now you make $1 million a year. And it only took you 8 years. Well, you got anything else better going on in your life? All I'm suggesting is you work really, really hard for the next 8 to 10 years, being conservative and disciplined, getting a consistent small return with very low volatility, and you're on a career path that can potentially make you a lot more money than you probably are dreaming of right now. It'll only take you 10 years. You're like, Wayne, I need to get rich this week. Isn't it? Compound it, Simon. I know it's more than 20. So is it 30? I was just throwing it out there. You're right. 40 is too much. So what is it? More, right? Yeah, see, Igor, so I don't want to, we're done our discussion, but you're talking like you're 16. Yeah. So good luck. Oh, so now we missed ISM. Thank you, guys. 56.4. That's a little bit of a miss.
Sharp increases in output and new orders, and staffing levels expanded at a quicker pace. Inflationary pressures remained elevated, says market.
Yeah, Simon. Yeah, so it's better, closer to 30.
Bills at auction on June 5th.
Okay, cool. So like Simon, right? Like if you earned 30% fairly consistently with very low volatility 4 or 5 years in a row, and you can sit down and discuss your trading history, good, bad, and ugly, with a client so that they understand the risks involved and understand your trading behavior and maybe your decision-making process, right? I think a lot of people would like 30%, right? Oh, then what just came out? All these alarms went off. What was that then? Sorry. Oh, market manufacturing PMI. That's what the other someone else was talking about. Who cares about that nonsense? Sorry. Just Trade the News threw out a bunch of alarms. Okay. Yeah. So Simon says, sure, right? Yeah. Well, so can we even say that like that's a reasonable goal? But you may be taking on too much risk right now, is what I'm trying to make, right? Right? So you can dumb down your risk so that you're only trying to get somewhere between, let's say, 0 and 5% per month. Okay? Right? Because you know if you can average 2, it's enough of a return. Then, with your smaller lot size, your volatility will go down. So really what you're trying to do is consistent returns with low volatility. Those are the two things you're trying to achieve. But if you have that businessman or business person's mindset, now you know that you have a product you can sell. You understand that? So now you can take that trade history, 3, 4, 5 years of it, because now you can prove to someone that as market conditions change, your returns are quite consistent, right? So that you can go to someone and offer a product. You're like, look, I have a product. I have a foreign exchange trading platform or program in which you can participate. And over the last, 4 or 5 years, through all these changes in the market conditions, we've produced this amount return with this amount of volatility. Do you find this attractive? Yes or no? Okay? And it's sellable. If that's what you're trying, like some people just want to make as much money as they possibly can as quickly as they can, and those are the 95% that fail, right? So what if you go in as a business person now and say, I want to have a sellable product. Now you're building, for the next 3 or 4 years, a sellable product. You're manufacturing a trade history. So at the end of 3 years, you have a sellable product. That's what you need to teach yourself now, that today and tomorrow and next week, next month, and next quarter, and the rest of 2018, and the rest of 2019, and the rest of 2020, your time, day in and day out, is not to get greedy and chase price and get all excited about some news or this country's going to bomb that country, or there's going to be a trade war here, or there's not going to be a trade war, and all this stuff. You get past all of that, and you're just above it all. and you're simply focused on building this sellable product so that 4 years from now, you can go out into the open market and find someone that is looking for you. And I can tell you that there is more money out in this world looking for consistent returns with low volatility and drawdowns than you can absolutely imagine. Now, no one's going to give you, like, you have 10,000 bucks in your account. He's not going to give you 10 million. Okay? But what could happen is then, you know, maybe you get it up to 100,000 and then 500,000 and then 2 million and then 8 million or 5 million and then 10 million. And, you know, and you just, over the next 20 years, you're attracting more and more money, and it'll compound very, very, very quickly. So you'll go from like 5 million to 12 million to 30 million. The standard model, which is actually changing, but the standard model is 2% management fee, right? So if you had 100 million, your management fee is 2 million a year, and then 20% of all the profits. What you'll find is in different parts of the world, they find different ways to avoid paying you the management fee. So you might find someone that says, look, I mean, I'm not going to pay you the 2 million. I'm not going to give you a $2 million or 2% management fee, but I'll give you 50% of the profits. You're like, okay, that kind of stuff. Oh, so that's just the management fee. Oh. Then there's the performance fee, right? So that's the 220 is your typical model, but it's flexible. It's whatever you negotiate. So you can do things like, if you invest less than $1 million, it's 30% performance fee. If you invest more than $1 million, it's 25% performance fee. And you invest more than 2 million, it's only 20. If you invest more than 3 million, you know, 15. Okay. Okay, now we're down to about 6 or 7 minutes. By the way, I hope you're enjoying the webinar. Once again, thank you to FX Street for being fabulous hosts. If you are enjoying this webinar, I invite you to visit tradersway.com and open at least a demo account. And by the way, if you're an account holder, I work every single day with account holders for free. So swing on by. The more I see, the less I know. I got to learn to let it go. Hey-oh. Listen to how I trade. Oh. Oh, peso, peso. Forgot about the peso. Thank you for bringing that up. Peso. Okay. Here's the Mexican peso. I am going to move my stop to break even. And that's that. Thank you. Carlos, my advice to young traders is look at it as a long-term business career and not as a get-rich scheme. Simon, I do webinars for Traders Way clients every day for about an hour and a half every day. Oh, you lost him, Hassan? Yeah, I entered yesterday as we kicked off of here. So we went up, we hit the pivot and it dropped, so you can see I sold there. So we'll see where it goes. My target for my peso trade, I mean it's not really a target because it's not a technical trade, but you know, it'd be great if I can get it down to here. Oh, you can see my limit's already there. So I'm targeting here. I don't really expect to get it, but it'd be nice if it did, right? So from my entry to my target is 12,000 pips. Ew. It's not a bad gig. Anyone going to buy some Rand? Yeah, Hassan, you probably sold too early or you moved your stop too quickly, one or the other. Remember, the trade's not even supposed to move until the 1st. So I don't know when you got blown out, but it seems like it was before the 1st, but it's not even supposed to kick in until the 1st. Do I use daily charts? Another good question. Sorta, but not really. So I sorta do. And the reason for that is my trades are already quite refined. So I know the lines I want to buy and sell. Very often the dailies correspond with that, but there's not a lot of difference between the daily and the 4-hour. So here's a 4-hour chart. I already knew that I wanted to sell peso around 1270. So how does the daily chart benefit me? So I mean, I understand it's all here, right? So look at this. That's the only thing interesting about the daily chart. Okay. So I'm like, okay, there's some resistance up there. And maybe on your daily chart, you got this going on too. So you're like, oh, I'm going to fib this sucker. Great. Right? Was it here? Right? Great. So 618, M3, right shoulder, head and shoulders type pattern. So on the daily chart, my trade plan or my trade strategy would be something like this. Okay? But I don't tend to set it up on a daily. I tend to do it here. It's about the same. Okay? So I set up a strategy. My strategy is to sell the right shoulder and trade it down. Then I have to use tactics. So remember my book, Strategic and Tactical Forex Trading. So the strategy here is sell the USD ZAR around 1270 because it's a pivot point, because it's a 618, and because it's a right shoulder. That's the strategy. Now the tactics is when do I pull the trigger. So in there I drop into a smaller time frame, like a 15-minute chart, for example, right? And you look to get short somewhere around 1270. Well, what does that mean to you? I mean, again, that's up to you. That's your trading tactics. But, are you selling the sweet spot, for example? Maybe. Okay, I'll just take that out. Oops, I guess take everything out. Does that make sense? So, yeah, I use daily, but not really. Oh, Simon says these obscure. You know how awesome South Africa is? Right? I've been to South Africa. It's not that obscure. You know how awesome Turkey is? Turkey's awesome. Okay? Mexico? Well, it's Mexico. Don't drink the water. Yeah, don't drink the water in South Africa. Don't drink the water in Turkey. I don't know. So these are all places that, was that it? The 10 a.m. Hang on, guys. You distract me so much. Here it comes. $58.7. Not bad. Prices going up. Whoop, whoop. You got to look at the employment subcomponent. Still not out. Cool. Well, there's a question here. What do you do if you're a day trader? Should you close your trades or let them go overnight? Well, if you're day trading, by definition, you wouldn't be holding trades overnight. So you're asking me more of a swing trading question. So for how many people here are interested in a thorough discussion on how to day trade? If you're interested in a 5 or 6 or 7 hour discussion on how to day trade, fund a live account at tradersway.com. You'll need to open a live account, go through due diligence, supply your documentation, and then once the account is open, you're going to need to fund it. On June 11th, with any live account holder with money in the account, you will be given access to a live webinar series. I call it a workshop, the day trading workshop. And I will spend at least 5 hours, probably longer knowing me, detailing every aspect you need to know about developing a consistent day trading strategy. Not some kind of like wonky rule-based system, but literally how to understand the market, anticipate things, and put together your own sort of strategy. It's more of a full understanding on the market dynamics and how to put together trades and anticipate moves before they happen, take advantage of the move, take your profit, and get out. And try again tomorrow. Okay? Kenneth says, I'm more interested in how to swing trade. I have a swing trading course at fxbootcamp.com that I think is like 16 hours long. And I also manage a swing trading group, but you can't join it now. The next opportunity to join my swing trading group is in late August, early September. Okay. So again, if you want to attend the day trading workshop, go to tradersway.com now, like now. Go through the application process to open the live account. Submit the required documentation for compliance. And then when that is approved, then you're going to need to wire money. And sometimes wiring money is not that easy. It takes time. And you need money in the account to get the event for free. So please start now. Don't delay. Can it be a $200 account? Yeah, sure, Jenny. Right? We'll grow it over time together, Jenny. Jenny works at diner all day. Jenny works her charts all night. Working for the pips. Working for the Fed. She brings home her pips for love. All right. So, the other thing I want to talk about this stuff here. Okay. Thuso, $100. Not 100 grand Thuso. 100 grand maybe, but not 100 grand. Yeah, dude, just put some money in, man. Okay? Dude, I'm not a salesperson, Andreas. Go to the website. If you're that interested, go to the website. All right. Yeah, someone else, why would I trade these? Okay, here's the other real reason. If you're short USD ZAR, if you're short USD Turkish Lira, if you're short USD Mexican Peso, if you're short Euro Lira, or whatever, that means you're buying ZAR, South African Rand, you're buying Turkish Lira, you're buying Mexican Peso. If you're buying and holding these currencies, you get paid interest every single day. Okay? Now, it's cool because if you buy stock, every so often you might earn a dividend, and other stocks don't pay you anything. If you own bonds quarterly or biannually or annually, depending on the bond, you get paid a coupon payment. In Forex, you get paid every day, interest payment. Now, on top of that, if you own stocks and the stock goes up, you don't get paid your profit until you get out of your position, which means you might be up, let's say, $100,000 profit in your stock market portfolio, but you can't trade the $100,000 because you don't own it. It's only paper wealth. You have to sell the stock, which means now you don't own the stock, but now you have the $100,000 profit. But you don't keep getting paid, right? Now, Forex is great because as you're earning profit, you can trade the profit. It's already in your account. It's mark to market. It's fantastic. On top of that, you collect interest every day. Now, the banks are closed Saturday and Sunday, so on Wednesdays you get paid for 3 days worth of interest, not just one. Even if you've only held the trade for 5 minutes, you get paid at rollover, which is probably 5 p.m. Eastern time. Okay? You get paid 3 days interest. And here's the other thing, okay? Let's say, I don't know what these pay off the top of my head, but they're great. But let's say Mexican Peso pays you 5%, okay? Every day you get 1 day's worth of 5% because it's 5% annual. Now here's the cool thing. $1,000 lets you buy $100,000 worth of a currency, right? So based on your $1,000, if it's paying 5% annual interest, right? You're not earning 5% on the 1,000, you're earning 5% on your 100,000, right? So you're going to earn 50% per year only in interest based on your leverage. Now, if you make pips on top of that, it's even better. But that's the major benefit of why these currencies. Notice how down here I call them high-yield exotics. Okay? You don't want to buy these pairs, ever. If it goes up, you don't want them. But if you can find a way to short them and stay short, let's say you short it up in here and you moved your stop loss to break even, so now your stop's here. Just stay short, man. The central banks, Anthony, you're lending Turkey money. You're lending Mexico money. You're lending South Africa money. Now, the money goes up and down in value, so you're hoping the money goes up in value because you're going to get paid back in that currency, right? And right now, you have to pay a lot to borrow the dollar, so you're going to be better off based on the interest rate differential selling Euro Turkish Lira than dollar Turkish Lira. So you're going to make significantly more money on this pair than USD Turkish Lira. Okay? So that's interesting. If you want to buy some Turkish Lira, This, by the way, this is also the all-time low. The Turkish lira has never been cheaper. So what if you just filled up your bank account full of cheap lira and held it for the next 5 years? And by the way, if Turkey decides to raise interest rates to counteract their weak euro, or sorry, their weak lira, and you're already lent them money, let's say you bought a Turkish lira bond. Okay? So here's a bond. There's the bond. Okay? And we'll make it look like money. So just for fun, let's throw in ellipse. Okay? There we go. And it was 1 year paying 5%. Do I really have to draw out 5? No, let's just do... Okay. Okay, so you lent Turkey money by buying a 1 year, or even say 10-year, or whatever, 1 year bond, 5%. Well, what if a month later, the Central Bank of Turkey raises interest rates to 10%? Do they call you up and say, hey man, we raised interest rates, so we're going to double the interest we're paying you for the next year? No. You hold a bond, they will pay you 5% at the end of the year, plus your money back. If you do the same thing through the interbanking system, if interest rates go from 5% to 10%, you get paid the increase. Boom. You get paid the increase, plus you're getting paid the pips. If this goes up, you jam your stop at break even, you get knocked out, and you've earned interest for a few days or a few weeks, and then no big deal, you got knocked out. But if you can stay this long term, you're earning pips, which are worth way more than the interest, but the interest is worth a lot. So again, how much money do you need? If you lent Turkey $100,000 or 100,000 euros worth of lira, how many euros do you need to lend them the 100,000? You need the 100,000, right? If you're leveraged 100 to 1 and you wanted to lend Turkey 100,000 euros, you only need 1,000 euros. But you're going to get paid 5% on the 100,000. So now you're earning 50%. You're earning $500 a year on your $1,000 investment. And you get paid day after day after day after day automatically in your account. And as that profit grows, you can even trade that profit for compounding. Or at the end of the year, if you're up, if you're up a lot, let's say you have $1,000 profit in your account in pips, you take your $1,000, plus you get your $1,000 that you put up as collateral back, plus you got your $500 in interest. So you've made, what is that, 150% return for the year. 150% return for the year. And if your stop was at break even 99% of that time, then you had no risk. And even though you're short, even though it's going up or down and up and down and up and down, your stop's at break even, you have no risks, so you don't care. Even on days when it's going up and you're short the euro Turkish lira, as long as the trade is still open, you still get paid the interest. So even though you're short and there's an up day or 2 up days or 3 up days, you're still collecting interest every day. And if it continues to fall further, you earn money on top of your interest. It's like so awesome. It's like, oh my gosh, right? And then you see that there are people out there scalping 8 and 10 pips at a time. And you're like, but this is what banks are doing. This is what hedge funds are doing. Yeah, Igor says, yeah, and then 1 year later, lira drops 300% against it. Well, your stop's at break even, so what do you care? Right? Look at this. If you sold this and your stop's at break even, right, it either stays below 5.5 or it doesn't. If it does, you get paid every day of the week and you can't lose money. Boom. Okay? Boom! Drop the mic, right? Hey, it was a nice webinar. Right, so. So like, for example, I could sit on this peso trade and never get out ever. I'm not saying that's good. Do you guys know why I shorted this trade yesterday? It's not the pivot. It's not the triple top, really. The real answer is it's a repatriation flow. So I know this weekend, $2.6 billion is going to move from the United States to Mexico. And so I'm trading the flow. It's a pure fundamental trade. I just happen to want to time it around the first of the month. Today is the first of the month, so I sold it on the 31st. And I did it because there was a triple top at a pivot. But I didn't do it because of the triple top and the pivot. I did it because of the flow. Then I looked for resistance, found my resistance, took a shot. My stop was above here. And then right before NFP, you saw me, I moved it to break even. And it did drop. I could have made these pips here, but it's not a lot of money, so I don't really care. But I could potentially, I'm not saying it's the right thing, but I could just leave the stop at break even and never get out. Because what if it made a lower low here? What's the next move? Technically, not fundamentally. What's the next move? Up, and it should be a lower high, which should create a lower low, which is now a downtrend. And it should do that for maybe forever. If the dollar starts to weaken, right, then that's great. So if it does this, then in a week or two, I'm redrawing my charts, not as a bullish move, but as a bearish move. I'm going to look at it, well, probably more like this, okay? And I could do something like this. I'm short forever. You understand? I could just never move my stop and just earn interest off the Mexican peso for the rest of my life and put this in my will and give it to my children. At my funeral, my attorney will pop out of the bushes and say, Senora, I have your peso, yink, right? And boom, they sit on this trade for the rest of their natural born lives, earning interest. Okay. Igor, I don't know why your messages are getting deleted, but why don't you just stand down for a while? Take a break, bro. All right. Did that pique anyone's interest, this idea of carry trading? Right now, a lot of people are using the dollar as a carry trade. The dollar pays a lot more than European currencies. Okay? Okay. Now, based on this lower low that it's made, I'm moving my stop to break even. It's a bit early, but I don't really care. Okay? Because it's lower low, lower high, lower low. This is supposed to create a lower high now. This is supposed to hit this price and fall. If it doesn't do that and wants to head back up, then I'm just not interested in the trade. I'll look at it again next week. Okay? So that's why I'm moving my stop here. Because if price is back in the zone, I'm just bored of it. Okay? So I'm not going to lose money, or I'm going to make a lot of money. More pips in this case because it's a small trade, but whatever. You got my logic there? Cool. Is anyone here going to attend my webinar, my Traders Way client webinar on Monday? Anyone with a demo account or a live account is welcome to join on Monday and on Tuesday and on Wednesday and on Thursday and on Friday. So if you are interested, there are quite a few people in the chat room here and at the webinar today that are regular attendees of that webinar. They're free. Just swing on by Traders Way, open a demo account. You'll be done in 30 seconds, and I'll see you Monday. Yeah, James. Yeah. James has attended my webinars for 10 years. Maybe more. Demo? Sure. Yeah, just demo. Demo it up, man. 7:30 in the morning, Eastern Standard or Eastern Time, whatever that is. So New York time. There's a button in your back office that says live webinars. Okay. What's the topic? Trading, trade planning, trade setups, technical and fundamental analysis of the day. Anything else that you want covered? If you say, hey, Wayne, I typically listen. Okay. So you tell me, what topic do you want me to cover? I think it was yesterday, I gave my advice on how to fix Argentina and South African economies, amongst other things. But, you know, sweating the small stuff, you know. So my new office is almost done. I think I'm moving in next week. It's so hot in here right now, I can't stand it. And I've had a construction crew building for 3 months, and they're supposed to be done yesterday, and they're not even close to being done. But I figured as much. So I'm super excited about that, moving into the office. I think it's slightly smaller. But so here's the cool thing. I had the whole office soundproofed. So the other thing I built I built a movie theater and I built a wine cellar. This wine cellar is climate controlled. The movie theater I had soundproofed. And while I had them soundproofing, because everything was just studs, I had them soundproof my office as well. So they spray foamed all the walls and all the ceiling and stuff. Really cool. And it's all drywalled up and stuff, but it's like working inside of a styrofoam ice cooler. So I'm really looking forward to getting in there. The wine cellar and my office are protected by thumb scanners. So you can get in either with a thumb scan or with my Bluetooth cell phone. So, I mean, I can't wait to get all that fired up. So that's me. So I'm not sure what you're doing with your, yeah, the 4K screen is 150 inches. 150 inch 4K. Booyah. So we did exotics, we did yens, we did dollars, we did commodities. Guess I just kind of want to check up on that. On oil and gold. Oh yeah, so how's that turning? How's that shaping up? Looks pretty good, right? Hey-oh, listen to what I say. Ooh. Trying to get into a smaller time frame here. High sense? No, actually, so it's not a LED or an OLED. I looked at OLEDs, but it's just, I mean, it'd be $25,000 or $30,000. So I'm like, nah, not on a TV, right? But I don't. My last movie theater had a light projector. You know, actually it was a 1080p at the time. A projector, right? It throws light. But the problem with that, you know, so imagine you're sitting in a perfectly pitch black movie theater, and then you have the light projector above you shining toward the screen. You're lighting up the whole damn room with your light bulb. So I bought a laser one that doesn't use light bulbs. So it's 5 times brighter, but it doesn't light up the room because it sits, I think it's 14 inches from the screen, but it'll fill a 150-inch projector screen. It just uses lasers instead of light. If you had a light bulb and you were 14 inches from the screen, you know, the image would only be this big, right? But with lasers, it's 14 inches and it's the whole wall. So I think the screen is 12 feet wide, so 4 meters wide, and I think it's 7 feet tall. So it's 7 feet by 12 feet. It's like, nice. Wait till you play Call of Duty on that thing. So. Oh, The Office? No, it's just this crap behind me. I've had them forever. I was thinking about getting rid of those. I don't need to, so I don't like spending money. I like making money. All right, so it looks like the market's pretty quiet. Nothing else is really going on. Everything that was supposed to happen has happened. WTI, right? It's bouncing right on my line. Look at that. So you either bought oil or you didn't, or you're going to buy it soon on the next dip or something. But yeah. Bab says, hey, take it or not. I don't know. I've already, right, there are 2 scenarios. This one that I have here, and I think this isn't the one I did today. I think this is but anyways. Or there's this one. Okay? There's one. So you either do this one or you're not. You're either a bull or you're not. But I've already explained, if you're a bull, 9 reasons why that would be a place to buy. And I also gave probably 10 reasons why you can't sell it. And I explained, if you bought it, the weekly and monthly outlook. Yeah. Eternal Soul. Yeah, there's no angle distortion because it's laser. Light bulb, you couldn't do it. It's just pure lasers. And it's like 5,000 lumen. So it's pretty cool. Yeah, a few trades. Not many, but a few. So anyways, thank you very much for attending. Thank you to FX Street for being wonderful hosts. I hope to see you at tradersway.com on Monday for our daily webinar. as a client. You can attend my daily webinars. If you open up a live account on June 11th, I'm going to do a 5-hour day trading workshop, an hour a day over the course of 5 days. So do that, start that process today, because you have to do due diligence and then you have to wire the money, and it always takes longer than you would like. That's just the world we live in these days. Okay. And I appreciate the thumbs up you've given to the webinar. I really appreciate that. Eternal Soul, yeah, that's pretty good. I was thinking, yeah, 355s. Yeah. I don't know if that's more than I have now, probably not, but maybe I could do like you're doing, 355s, and then I think you'd need more on in 3 standards, so maybe 6 standards and 355s. I mean, that might be cool. Never thought about that. So thank you for sharing. Okay. The other thought would be 655 4Ks. But that's not that easy to do on one PC. You start to get some problems. So, but whatever. I got bigger concerns in life than that. Besides, people heckle me over this. They're like, Wayne, you must be an idiot because you have 18 screens. You suck. I'm like, yeah, you're a bitter little dwarf. Like, when people get so angry, I'm like, why do you care how many screens I have, and why would you get so angry? It's just so funny. Right? We need more love in the world, don't we? With that in mind, peace on earth. May the pips be with you. May your profits be above average. And I hope to see you on Monday at tradersway.com for our daily live webinar. And I hope to see you next first Friday of the month for Trade Non-Farm Payrolls 147. And I will be conducting that webinar live from Harvard University. Should be interesting. Right? Wicked smart. Thanks, guys. Have a wonderful weekend, huh? Bring more love and joy to the world. Cheers.